When national banks became European risks, they were built to serve local economies. They answered to national regulators. Yet their failures shook the entire continent. To understand how national banks turned into European risks, we have to look at how identity lagged behind reality. Because while balance sheets expanded across borders, supervision, politics, and public perception remained firmly domestic. For decades, banks were symbols of national stability. They financed households, supported businesses, and operated under familiar rules. Their risks were assumed to be local, manageable, and ultimately contained within national boundaries. But integration changed the equation. Banks began borrowing internationally. They invested beyond their home markets. They relied on foreign funding and foreign counterparties to sustain daily operations. What appeared domestic on the surface became international underneath. Still, responsibility did not move. Governments believed their banks remained national assets. Regulators focused on home institutions. Voters assumed problems would be handled locally. The system carried two identities at once, and no one forced a choice between them until stress arrived. Losses in one country spread through funding channels into others. A bank struggling at home suddenly mattered abroad. What had once been a national concern became a European threat almost overnight. This created a dangerous mismatch. Banks operated across borders. Risk traveled freely, but accountability stayed at home. When intervention became necessary, the question was unavoidable. Who should act? The country where the bank was headquartered? The countries where it operated? Or the system that depended on its survival? No answer came easily. National governments hesitated to support institutions whose risks extended beyond their voters. Other countries feared exposure to decisions they could not control. Delay deepened uncertainty, and uncertainty fed instability. Markets sensed confusion. Funding costs rose. Confidence eroded. Institutions that looked solid on paper became fragile in perception. The label national bank no longer matched the reality of their impact. Europe had reached a turning point. Banks could no longer be treated as national problems in a shared system. Their failures carried consequences far beyond borders. And without a framework to manage that reality, every shock threatened to become systemic. This was the moment Europe realized something uncomfortable. National banking identities no longer protected European stability. They endangered it. The mismatch became impossible to ignore. As pressure mounted, national authorities acted first for their own systems. Capital controls were discussed. Emergency guarantees were designed to shield domestic banks. What protected one country often strained another. Fragmentation accelerated. Banks began retreating behind borders. Liquidity was held locally. Lending decisions favor home markets. The integrated system that once promised efficiency now produced division under stress. This behavior was rational. It was also dangerous. When every institution protects itself, the system weakens as a whole. Cross-border trust evaporates. Markets become segmented. The very mechanisms that once spread risk evenly now concentrated unevenly. Regulators face a dilemma. They could demand solidarity without authority, or enforce control without legitimacy. Neither option worked in isolation. Supervision still lacked a clear European mandate. Resolution tools were national. Political accountability stopped at borders, yet the consequences of failure did not. Every intervention risked spillovers no one fully controlled. Banks learned quickly. They adjusted structures to reduce exposure to foreign decisions. Subsidiaries became more independent in appearance, but remained financially linked. Complexity increased, not to expand, but to survive. Public perception shifted as well. Citizens no longer saw banking failures as abstract events. They saw consequences in employment, public finances, and trust in institutions. What had once been technical debates became social questions. Why should one country pay for another's bank? Why should national budgets absorb European risk? These questions had no easy answers. Europe had built a shared financial system without shared ownership of failure. As long as banks were national in name but European in impact, every crisis would reopen the same debate. The problem was no longer economic. It was structural. And without addressing that structure, stability would always depend on improvisation. Europe needed a way to treat banks according to how they actually operated, not how they were labeled, because labels do not stop crises. Structures do. The strain pushed Europe toward an uncomfortable conclusion. National tools were no longer enough to manage European risk. Banks had grown beyond the reach of individual governments, yet depended on them in moments of failure. This imbalance created paralysis at the worst possible time. Every delay carried cost. Markets demanded clarity. Investors wanted to know who stood behind the system. Uncertainty about responsibility became a risk in itself. Even healthy institutions suffered when doubt replaced confidence. Attempts to improvise revealed the limits. Ad hoc cooperation helped temporarily, but it lacked force. Decisions required negotiation instead of execution. Time was lost debating jurisdiction, while stress deepened inside balance sheets. Banks felt the pressure. They tightened lending further. They reduced exposure to weaker regions. They prioritized survival over integration. What had once been a shared system continued to fragment, reinforcing the very risks policymakers were trying to contain. This fragmentation had real consequences. Credit conditions diverged sharply between countries. Businesses faced different costs based on geography, not fundamentals. The promise of a unified financial market weakened just when it was needed most. Europe faced a stark choice: accept that banks were European in risk but national in control, or redesign the system to match reality. The first option meant recurring crises. The second required surrendering authority. Neither was politically easy, yet the cost of inaction was clear. Every unresolved failure increased distrust. Every temporary fix deepened structural weakness. The system could not stabilize while responsibility remained divided. Pressure mounted for a permanent solution, not another emergency tool, not another short-term guarantee, but a framework that treated banks according to their impact, not their passport. One that aligned supervision, resolution, and accountability at the same level as risk. This was not about integration for its own sake. It was about survival. Because as long as national banks remained European risks, stability would always be conditional, and Europe could no longer afford conditions. The resolution came through alignment. Europe accepted that banks could no longer be governed by national labels alone. Risk had crossed borders permanently, and responsibility had to follow. What emerged was not a sudden revolution, but a structural shift towards shared oversight and shared consequences. Supervision moved closer to the source of risk. Large institutions were no longer viewed only through national lenses. Their balance sheets were examined as integrated wholes. Decisions considered continental impact, not just domestic exposure. This reduced ambiguity, even when it did not eliminate tension. Resolution frameworks followed. The goal was no longer to ask who should pay after failure. It was to decide in advance how failure would be managed. Losses were meant to fall where risk had accumulated, not where political pressure was weakest. This changed expectations. Banks understood that nationality would not guarantee protection. Governments understood that unilateral action could undermine collective stability. Markets adjusted to a system where responsibility was clearer, even if it was shared. The transformation was imperfect. Sovereignty was not erased. Politics still mattered. Compromises shaped outcomes. But the direction was unmistakable. Europe moved from improvisation toward structure. What remained was vigilance. Because integration creates strength only when accountability matches exposure. When authority moves as freely as capital. When responsibility cannot hide behind borders. European banking learned that lesson through crisis. National banks had become European risks. European solutions became unavoidable, and the stability that followed was not built on illusion, but on alignment. So what do you think? Are we repeating the same mistake again? When